Hello everyone. In this video I'm going to continue to show you how to calculate the weighted average cost of capital for a firm. Specifically what I'm going to do is take the workbook that we did in the last video that has these three tabs on it, CAPM, DCF for discounted cash flow, and BY, PRP, which is bond yield plus risk premium. And I'm going to add three more worksheets to these, and I'll put these worksheets out online for you to add into your workbook as well. And before I do that though, the first thing I want to do is explain one change I've made to the existing workbook. In preparation for this video, I went out, recreated all the steps for the workbook that I used in the last video, and I found out that I was just getting an error message for this forward PE. And so what I decided to do was change the equation up here, because before what it had up here, if you go back, it had a comma and then the date here. I put that in and it gave us a forward PE ratio for that date. Unfortunately now it doesn't work, and so I just took that out. And so what this is going to do is, there we go, it's just going to tell you the forward PE ratio right now. So for the Fed model, what I also did then was take out the date here on the risk-free rate, just because, so we have the right forward PE on today's date and the right risk-free rate. Okay, so and putting those two things together. That's why if you look at your worksheet, it's going to look a little bit different than mine on this one. And again, all I did was I took out M1 at the end of each of these formulas. And so it makes a small change. It wasn't that large. This went down by about 1%, which really isn't surprising. It's still very much in line with some of our other estimates here. So the second workbook I'm going to include, I'm going to pull sheets out of it. It's out on D2L. It's the cost of capital additional worksheets. The four worksheets we're going to add in are user inputs, and I created this just because I was using the same user inputs each time. Synthetic debt rating, this one actually comes from a website from Aswath Damodaran. It's very well known. I've used it in research papers. I know other people that have used it in research papers. It provides an estimate for the cost of debt for a firm if the firm doesn't have a bond, or maybe doesn't have a bond that is representative of what it would actually be for the cost of debt for the firm. I'll show you how to use that. Capital structure, we're just going to look some things up on CapitalIQ to fill in these. And then finally the weighted average cost of capital calculations, and I'm going to show you how to use drop-down list in these to use all these different estimates to get different weighted average cost of capital. Okay, so let's get started here. I'm going to go out to user inputs, this one right here. I'm going to go over to the cost of equity calculation. We'll rename this workbook at the end. So the next thing I want to do is add in this user inputs worksheet. So I'm going to go down here. This is on the cost of equity workbook that you have. I'm going to insert a worksheet. I'm going to copy and paste this, and I'm going to add a few other things on here. So I've got the ticker. I also want to include, and we're going to get the company name here. The yield to worst, or hopefully it's the yield to maturity on the firm's 10-year benchmark security. The risk-free asset identifier, risk-free asset name, and the market proxy identifier. What that means is that's the security that we're using to identify the market return, and then the market proxy name. Right. And so the first thing I want to do here is go to the CapitalIQ add-in. Oops. Sorry, clicked the wrong thing. Formula Builder. and click on ticker, and then the general, and then I want the company name here. Oops, yep, there you go. Add formula, and then apply. It's going to give me too many. I'm going to take that one out. Okay. And then close that out, and you can't see up there, there's a little X. What we were using last time was Pepsi, so that's what we'll start with today. The yield to worst on the 10-year benchmark security, and this is one we have to look up. So I'm going to go out here to CapitalIQ, and I've already got the page pulled up, but just to remind you where that's at, I go down here to fixed income and press summary. This will take me back to this page. It's 1.992. This is the benchmark 10-year security. So it's 0.01992. So we have that. The risk-free asset identifier, what we used last time, I've got right up here, risk-free rate. The identifier is this one. I want to include this in on the first page because we do use it a few different times, and it gives us an opportunity to identify, make sure we're using what we expect to be using here. And then again, I'm going to go to Formula Builder. The cell is B6, and then again I'm going to go to Company Info, General Company Name, Add Formula, and then apply that. And it's got the United States Treasury constant maturity 10-year. That's exactly what we want. The market proxy, I'm going to go out here, and mind you, I'm not pressing equal on that one and then saying it's equal to this. I'm actually just moving it over. I'm copying and going back over here, and I'm pasting right there. And then I'm going to use the same formula builder. The cell now is B8, and then general, company name, add formula, apply, and we get the Wilshire Mutual Funds Inc. Wilshire 5000 Index Fund. So this covers 5,000 different securities. So it's, at least in my opinion, it gives us a better feel of the entire market than the S&P 500, which is just large stocks. All right, so we've got this first page filled out. I'm going to go down here and right click on sheet 2 and rename this to user inputs. And now what I'm going to do on the existing worksheets that we've completed, I'm going to go back, and anywhere I find one of these, I'm going to point it back to this user inputs. There we go. All right. So for the CAPM, the market index, I'm just going to put equals. Go back to user inputs. The market proxy identifier. Risk-free rate. Again, I'm going to do the same thing here. I'm going to put equals. The risk-free identifier. And then the firm. Again, I'm going to just go here. And the reason I'm doing this is when I was completing the next set of worksheets, I found myself having to go through and double check that each of the worksheets matched up in terms of the different inputs. So if we just keep them all on one page, we can just set them there and then have them fill in throughout the workbook. All right, so that's everything on that CAPM page. The discounted cash flow page, again, I'm going to go here, press an equal, B1 on the user inputs. And that is it for that page. And then finally the bond yield plus risk premium. I'm going to set this equal to, and if you notice, when I looked it up today, and today is April the 8th, the yield on their long-term bonds has fallen, and that's probably because the overall yields have fallen due to the Federal Reserve changing their rates. And then I'm just going to take this off because we don't need to look it up for that page anymore. I'm going to set the risk-free rate over here, the risk-free asset identifier, And then the firm, I'm going to set to the ticker out here. I'm going to take that highlighting off because we don't need to, again, we don't need to do anything with it now. All right. So that sets us up for where we're going to add in the rest of our spreadsheets. Now, the next two worksheets have to do with the next, let me see. Yeah, the next worksheet has to do with the synthetic debt rating. This worksheet, I'm going to add a worksheet down here onto our cost of equity calculation workbook. And then I'm going to go out here and copy this. I did not make up this worksheet. This is a worksheet that is available online. I made one adjustment to. It is available online through Aswath Damodaran's website. Oh, I'll spell that out. He's got a lot of good information out there. I've used this worksheet and the synthetic bond ratings from him in research that I've done before, in published articles, and I know there are people that have as well. So he's pretty well regarded, and this is available on his website. What we're going to do on this page, though, is we're going to add in a few some information here. You can see in his notes your most recent year's operating income is unusually low or high. You can use the operating income for the last few years. Enter the interest expense from the most recent income statement. I think that probably says. And then he says in here, I use a 10-year government bond rate, which is actually the same rate we're using. You can enter in the firm type up here. 1 is a large manufacturing firm. 2 is a smaller or riskier firm, and small means that it's less than $5 billion. Most of the companies we're going to look at do not fit that category. And then finally 3, which is not up here. Yeah, 3. If it's a financial service firm, so it's a bank. And so what this does is that it looks at these different tables to get the spread. So the spread is the difference between the rate, the risk-free rate, and the rate for the bond, a 10-year bond for a firm, based on the times interest earned ratio. And that's what it's calculating here. The interest coverage ratio is the same as the times interest earned ratio. It's EBIT divided by the interest expense. And so what I'm going to do here, I'm going to put up here the ticker, set that equal to the ticker on the first sheet. Okay. And then, so Pepsi would qualify as a large manufacturing firm. So I'm going to put that in there. I'm going to put in, using CapitalIQ formula builder, I want the earnings before interest and taxes. So my cell is going to be H1 for the ticker. The financials, I want to go down to financial ratios. Oh, sorry, I don't want to do that. I want to go to income statement. I'm going to scroll down here. And so our EBIT is our operating income for the firm. And I'm just going to have it put in the current value of this. So it's probably going to be the last 12 months. We can double check that. And then the current interest expenses, I'm going to do the same thing. Cell is H1, income statement. Scroll down to, we don't want interest expense finance division. We want interest expense down here. There we go. I'm going to add in that. Apply. And I want to make that a positive number. It's going to show up here as negative. So what I'm going to do is put in ABS, which stands for absolute value, and then just include it that way. Oops. Oh, used the wrong one. Sorry. All right. So down here, I want to make this the absolute value because sometimes it shows up as a negative. There There we go. And then the current long-term government bond rate, I'm going to put in here equals formula builder. My cell is actually going to be, and you could put it on this page as well. I'm going to go back to user inputs, my risk-free identifier, go out to market data, equity market data, last sale price, add the formula and apply that. And then it's not 75%, it's actually 0.75%. So I'm going to divide that by 100. And I get here that my output for Pepsi is that its interest coverage ratio is 9.45. It's got a AAA bond rating, which is slightly different than the one actually. It's a step higher up from what they actually have. But their estimated cost of debt on here is 2.01%. If you look at here, when we looked it up, it was 1.99. So very close estimate in this case. Sometimes they're a little bit off, but in this case, the synthetic cost of debt is very close to what they're actually paying. So that's a nice thing to see. So we've got that. And I'm going to rename this page Synthetic Debt Rating. I'm going to save that. So the next thing we're going to add to this workbook is the capital structure for the firm. This is pretty straightforward. I'm going to go back out here to, not there. There we go. Here's the cost of capital additional worksheets workbook. I'm just going to copy this. I'm going to paste this. This is pretty straightforward. We're looking up the capital structure for the firm. So the first thing we're going to do is include the market cap, which is the market value of the firm's equity, the total market value of the firm's equity. When I was playing around with this, I did add in preferred stock or preferred equity. What I found is that, and what I found over several years is that pretty typically the primarily firms that have preferred equity are banks or financial institutions. I put some in here, and you can certainly do this, but it wasn't very meaningful. While they had some preferred stock, they didn't have much compared to their overall capital value. And then we get into another issue with determining the price or the required rate of return on that preferred equity. So I decided to leave it out. It's going to be rare that you need to include that, and certainly, we can, if that's something that comes up in class, I can certainly work through that with you. If you're looking at a firm that has some preferred equity, I can help you along with that. But in general, it's something you're not going to see very often, and so I decided just to leave it out here. So the first thing we're going to do is put in the market capitalization for Pepsi. We do that by going to Formula Builder. The cell in this case is B1 for our ticker. Market data, equity market data, and I want market capitalization. There's a lot of different options here. We're just going to go with the straight capitalization. And we're going to leave date blank and just use today as our date. Add that formula and then apply. And then I'm going to go out here to home. So their market cap right now is $181 billion. So this is in millions of dollars here. And that's going to be the same for the total debt. I'll show you out here. Let me pull up CapitalIQ to show you what total debt is. I'm going to go over here on the left-hand side to capitalization. See if that's what we want. So total debt. You can see here where they've got the total enterprise value and total capital. They calculate it a little bit differently. You can see how much their stock price has fallen here. Compare that 203 billion to what we just put out there. But we're interested in the total debt here. total debt consists of, really what we want is our interest-bearing debt, and so it's got short-term borrowings, that's an interest-bearing debt. Current portion of long-term debt, current portion of capital leases, so we're including capital leases in this, which is appropriate. And so we're getting our interest-bearing debt, and then there's banks templates, and then all other templates are somewhere else. But the primary ones we're looking at are the standard template and maybe the bank's template if you're looking at a bank there. So this total debt is not total liabilities, it's that interest-bearing debt for the firm. So cell, we're looking at total debt, so I went to financials, debt capital structure, and then clicked on total debt, add formula, and then apply. And again, I'm going to make that look a little better. And then our total capital is the sum of the two. The weight of common equity is equal to the market capitalization divided by the total capital. The weight of debt is equal to the total debt divided by the total capital. Those have to equal to 1. I'm going to rename this page capital structure. And then that leaves us to our last page. So for our last page, we're going to calculate the weighted average cost of capital. Let me go out here to this page. I was putting some some equations on last time. We're going to name this, rename it when we save it, but our weighted average cost of capital for a firm is equal to, it's going to be our required rate of return on equity, which is R sub S, right here. Well, actually, we're going to start off with something else. Sorry about that. We're going to start with the weight of equity, W sub S, multiplied by our required rate of return on equity. There we go. R sub S plus the weight of debt multiplied by the cost of debt, R sub D, multiplied by 1 minus the tax rate. And we take out the tax rate because, and that's the T stands for tax rate. Let me just put in, I'll spell all these out real quick. W sub S there we go. It's the weight of common equity W sub D is the weight of debt. And remember, this is interest-bearing debt. R sub S is the required rate of return on equity. And then R sub D is the required rate of return for debt, and then T is equal to the tax rate for the firm. And for any of these numbers, especially the required rates of return of debt and equity and the tax rate, if you get a number that looks wrong, so in some cases you might see a negative tax rate, and in those cases, and this is just calculated on S&P Capital IQ, if the firm has a negative net income on the books that year but still paid taxes, their tax rate's either going to show up as negative or it's going to say NM. And so that's where you need to go, and you'll need to look at the financials for the firm. And I'm going to show you how on this last page you have the option of putting in your own estimate and not just using what is available there on Capital IQ. All right, so we're going to calculate this on our last sheet. I'm going to go over here to my new worksheets that I'm putting out there for you. I'm going to highlight this information here. Bring that over to our new or our old worksheet. So I'm going to add a new worksheet there. I'm going to size all these out right. And so what we're going to do here is we're going to put in all of our estimates for each of these, the cost of equity, the cost of debt, and then the tax rate. I'm going to show you how to put that in there. And then I'm going to show you how to put this all together to calculate the weighted average cost of capital. The first thing I'm going to start off with here is the ticker. I'm going to press equal and go to the user inputs. There we go. Cap M, and this is a little monotonous. I'm just going to go to each of the estimates and plug it in. On these discounted cash flow ones, make sure you're looking at the right ones. So down here where it says cost of equity is my correct one. So retention growth, analyst estimates, historic growth, they're all in the same place on that workbook, or excuse me, that worksheet. And then if I'm looking at these and I say there's not one on here that really I feel is correct, I can put one down in here and just use a different estimate. And I'll demonstrate that here in a few minutes. Cost of debt estimates, my synthetic cost of debt. So for my synthetic debt rating page, I'm going to select the estimated cost of debt right there. The yield to worst on the 10-year benchmark. So go to user inputs, yield to worst there. And then again, you could put in your own number in this case. If you felt like those are off, honestly, there's a 2 basis point difference between those two estimates. So I'm going to say 2% is probably right on the money for Pepsi there. The tax rate. So here what we're going to do, and this is where you can get a weird answer from Capital IQ. So you might consider, if it doesn't seem right, or even you want to double check, just go and look at their financials and look at what their effective tax rates have been over time, because this is the number that can go up and down quite a bit in a year. But for now, what I'm going to do is go to Capital IQ, go to Formula Builder, my cell again, my identifier cell is going to be the ticker there, C1. I'm looking for the effective tax rate. That's going to be on the income statement. I'm going to scroll down. It's going to be down a little bit. There it is. Okay, effective tax rate. Add formula. Apply. So the effective tax rate, and then this is another one you've got to divide by 100. And just take note of the name up there, IQ effect, underscore effect, underscore tax, underscore rate, in quotation marks, and you don't need to look it up like I did. You can just put that in there if you want. So their effective tax rate was 21.04%. That doesn't seem too weird. Again, we can play around with that a little bit if we want to. And I'm going to highlight this cell just as a reminder that you can put your own number in there. All right, so now the last part is filling in that equation, weight of equity multiplied by the cost of equity, weight of debt multiplied by the cost of debt, multiplied by 1 minus the tax rate, and we're going to add those two products together to get the weighted average cost of capital. I'm going to do something a little strange out here. In this cell, I'm going to give myself, actually this cell down here, I'm going to give myself some options. I'm going to go to data. So this is for the cost of equity. Your ribbon up here might look a little different. What you're looking for, and when I was doing this on my other computer, there's more stuff on this ribbon, and it was a tiny little thing, but you're looking for under data, go to data value validation, And this top one here, data validation, click on that. So it says any value, but what actually I want to put in here is a list. Okay. And then my source of this list is going to be these cost of equity estimates, the names for them. All right. I press OK. And so I'll just click on that down arrow, put CAPM in. And here I'm going to put in a VLOOKUP. So a VLOOKUP stands for vertical lookup. There is an HLOOKUP too, and that is a horizontal lookup. The lookup value is going to be CAPM, whatever is in this cell, E13. My table array, the table I'm looking up from are these cells up here. So it's going to be B4 through C8. So it's saying look within this table to find the value, comma. My column index number is going to be 2 because I want to know the input. You know, I'm going to have it look up whatever value is in this first column, and that's how a VLOOKUP table works. It looks up the name in the first column, and then it provides the value in whatever the column index number is. So I want 2 there. I want an exact match, which shouldn't be a problem because I made the list up from those exact cells, so that should work well. And that's how that works. And so if I want to, so you can see here I'm using CAPM, it puts in the 5.47. Let's say I want to change that and use retention growth. It's going to change that estimate to the retention growth rate estimate. My weight of equity comes from the capital structure. It's just that number right there, B7. My weight of debt comes from the capital structure table again. My cost of debt, I'm going to do the same thing over here. So I'm going to go to data. Well, I'll go to a different ribbon to show you how to do it. Data there. Data validation. And then because I've got that cell selected, I'm looking at E16. I want to go to a list. And the source is going to be these 3 different options here. Press OK, and then I'm just going to select one, synthetic cost of debt. Then go over here and put in again VLOOKUP. My lookup value is going to be whatever is in this cell. My table array is going to be E4 through F6. Okay. And then I'm going to put in false for an exact match. Oops. Oh, sorry, I left one thing out there. I'm going to put in 2 and then comma. And there we go. All right, so the inputs for that are VLOOKUP. You're looking up whatever is in E16. Within the table E4 through F6, you want to find what's in column 2. And then you want the exact lookup number, the exact lookup, not something close to it over on the left-hand side, which it really wouldn't matter in this case. It might affect the outcome over here. Then finally the tax rate. Because I'm going to have 2 different options here, I'm going to make another list. Again, go to data validation. For E17, click the list. Oops. Sorry, I said OK before I finished. I'm just going to highlight those 2 names there. Press OK. And then again, I'm going to put in here equals VLOOKUP. I'm going to look up the value that is in E17. My table is over here. My column index number is 2. And then again, I'm going to put in false. And so that is all the inputs for the weighted average cost of capital. Now I'm going to put in equals the weight of equity multiplied by the cost of equity plus the weight of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So using these estimates, I get a weighted average cost of capital for Pepsi of 14.17, which is probably on the high side because I have the highest estimate up here. If I change this maybe to something more reasonable, the analyst estimates, then it changes that estimate. I can put it down here. Let's say, you know what, I think it's going to be in this range here. I'm just going to say it's going to be 10.75%. And I can put that in there, that estimate in there. I can go over here, use other estimate, and it's going to use my estimate now. All right. One last thing, let's rename this to weighted average cost of capital. And that's it. Again, for cost of debt, you can actually put another number in here. Let's go and let's look at Apple. And again, what I have to do here is look up their benchmark security, if they have one. Some companies don't. And then I'm going to go down here on the left-hand side to fixed income summary. And theirs is very close to Pepsi, 1.996. Didn't really change much there. And so now I can, everything's in here that needs to be in here, I hope. We'll find out. And yeah, it all filled in. So here's the weird thing about Apple. They have a negative, this is weird looking. Okay. I was having some problems with this earlier today. Because this shouldn't be negative. If you ever do this, what I just did, which wasn't very bright on my part, I clicked on a cell, and now if I press enter, it's just going to give me this annoying beep. Press escape, and then you can get out of that. All right. Or if you try to change something, that would even be worse. And then if I try to click out here, it just messes it up. So again, you just want to press escape, and then you can get out of there. I was having this problem earlier looking up some of these options here, and I'll show you. So Walmart's looking right. Let's try Tesla. That's interesting. That one's just something different. Now this didn't work well because they didn't pay taxes. They didn't show a positive net income. We can see this here with their retention growth rate. That ROE is negative because Tesla lost money last year. So we get some weird numbers there, and that's where you'd want to maybe say, okay, I'm going to use a 25% tax rate. Actually, sorry, 0.25. And you can see their synthetic cost of debt is really high because they lost money. Their coverage ratio is quite bad. I'm going to try Apple one more time just because that bothers me. Yeah, they're coming up with a negative beta, which is, like I said, kind of strange. Let's try one more. And that's, let me just go to Apple real quick. So we can just ignore this. We get two estimates here that are pretty close together. And so, you know, I think about 12%, 13% is probably pretty accurate for Apple. And that's why it's nice to have different estimates available to you. Their synthetic cost of debt, again, that was recalculated for Apple at 2.01%. So it came in about the same as what Pepsi would be. And again, that's also very close to what they have. Their tax rate's 15.09%. So if I use that, I get a weighted average cost of capital. Here I'm going to change this to, go with their analyst estimate, about 12%, which seems reasonable for that company. Let's do Microsoft. All right, and again, I have to look up. I have to remember to do this for Microsoft. What is their benchmark yield? There we go. So theirs is kind of weird here. It's less than 1%, which is less than the risk-free rate, which does not make a lot of sense. So let's go out here and look at. So in this case, this is not one where I would use their benchmark rate. I'd look out here at security summary. And then I'm going to look for about 10 years out. And my column that I'm looking for is the current yield to worst right here. At around 10 years out, it's low. We got one here that is 2.137, 2.358, 1.022. That's, again, pretty low. I'm going to go with this 2.137. So you can see there's kind of a leap here. So I'm going to put not here actually, because that would be inappropriate. It's not their correct one for them. And we can see that 2.137 is pretty close to the synthetic cost of debt. DCF retention growth, that's kind of high. Their analyst estimates seem kind of high as well. And again, we're getting that by taking their dividend yield plus the estimated growth rate in their earnings per share. If I use historic growth, I get a lower number. Again, it's part of this is just you determining, looking at that and saying, does this look right or not? Is an effective tax rate of 11% really appropriate for Microsoft? So I'm going to go out here and look too. Their income statement. I'm going to scroll down here to their effective tax rate. We can see here 11.1%. A little lower. I mean, they had a pretty high tax rate in 2018. This is the last 12 months, so their actual fiscal year end, they had one of 10%. So maybe it's not too far off. That's something certainly you can play with and make some decisions there if it looks appropriate to you. The only thing I ask when you change things like that, when you put in your other estimates, just provide an example or an explanation why you decided to use a different estimate. And it might be that, in the case of Microsoft here, we've got a pretty wide range, and so I could put in here, based on the range, these look maybe like they're a little better estimate. This retention growth rate, hopefully, rational investors are not requiring a 29% return on Microsoft. So that one kind of seems out of the range of what would be acceptable there. I hope this helps out. Let me know. I went through a lot in this video. Let me know what questions you have when completing this. Our next step is going to be estimating the cash flows. Hey everyone, when I was finishing looking over that video and getting ready to put it out on D2L for you, I realized I made a mistake. Not a big mistake, not anything I have to go back and fix, but I had forgotten to put out here the bond yield plus risk premium estimates. So I'm going to go ahead and do that now. We calculated this last time. We had three estimated cost of equity calculations here. So I'm going to go back to our weighted average cost of capital spreadsheet, and I'm going to add these in. So what I'm going to do is I'm going to put my cursor on row 8 there, right click, I'm going to insert three rows so I can add that in. And this goes to right here. So here are my my three different estimates. The first is I'm going to put in here bond yield plus risk premium beta multiplied by ERP, bond yield plus risk premium, historic firm risk premium, I'll just put RP there for risk premium, and then finally BYPRP. I think I just have on here the Fed model. Let me just double check that. Yeah, Fed model. Now I'm just going to set these equal to the numbers on here. So we get even more estimates for the cost of equity. And now the only thing else I need to change is my list here. So actually you can see here what happened when I added those in the way that I did, because I added them within the current list. If I put these on at the end after the other, they probably wouldn't have shown up here, but now they're also included in my list here, and I don't have to really redo anything there, which is nice. So now the video's over. Let me know if you have any questions. What we're going to do next is look at the cash flows for the firm. We're gonna, and that will kind of take us to the end of the absolute valuation models. The three models we're going to look at are dividend discount, the free cash flow to the firm, and free cash flow to the equity holders. And then after that, and that's going to take, here in a few days I'll make another video on that, and then that'll lead us to your next assignments, which you're going to value an existing firm in our portfolio, one that we might consider getting rid of, and then have you look for maybe a replacement firm, something else for us to use to invest in possibly for the portfolio. So your assignment is going to be to use those absolute value models and then some relative value models that I'll also show you. Those aren't nearly as complicated. And then you're going to use those to complete the last two assignments, which are going to be pretty similar. And that's it. So please watch this. Let me know what questions you have. I look forward to talking to you soon.